But so we want to welcome everybody to our March breakfast meeting. It'll be our last breakfast meeting of this winter season, just in the anticipation that by the time we get to April, hopefully everybody's going full steam with planting progress. If the weather continues to stay nice here. We will send this recording out later for everybody, but we wanted to kind of do this as a dual meeting. So we're going to start the first part with the Moorhead updates, and then the second part, after I'm done talking about the Moorhead update crop information, is I'm going to go into an abbreviated version of our marketing update as well, to kind of kill two birds with one stone there. So I'm going to share my screen, and then I'm going to turn over to Ron. Ron's going to talk about the Moorhead, and the state executive summary and the Moorhead averages.
Okay, good morning, everyone. What you see up on screen is a PDF of the 2020 state executive summary. And I just thought that's a good place to start to discuss our findings from the 2020 financial farm business management database. Our front page has our pie chart that just illustrates the dollars on average spent by a farmer in the state of Minnesota last year. And so you can see the breakout or the total average approaching $1 million. We also did a chart like this for the Red River Valley, and the Red River Valley farm on average is actually spending even close to $400,000 more than our Minnesota state average. So that's over 1.3 million on average for 2020 spent by the Red River Valley farms. And actually our Moorhead average shows a little bit more than that again. So just to give you an example of the impact that each of our farms in general has in the area and regional business communities. So on to the page 2. And I do have to, credit my partner in crime, Mr. Josh. He's the person in charge of putting this document together. This page, the map on top, is something that we added for the first time to this document, which a map of Minnesota illustrating how many different farms in farm business management had financial data that went into this document. So again, you can see the powder blue color, is the only one farm or up to 9 farms. So that northeastern Arrowhead are far northern counties. I know, for example, like Lake of the Woods County at Warroad, Baudette area, there's only one farm. And a lot of that is just due to lack of having an FBM instructor that lives in that area at all. So all of that northeastern part of the state is being covered by those of us working out of the Thief River Falls area and or our Boston office, or there's a couple instructors out of the Staples program in with South or Central Lakes College that gets up and serves those Arrowhead, Iron Range counties. But just kind of a illustration of the coverage and the fact that we do have a presence in almost every county in the state of Minnesota. So again, in the second paragraph, just talking about the economic impact of the 2,246 farms that made it into the database this past year. They provided over $2 billion. Again, you can see there $2.132 billion was spent in there by those farms this past year. One of the other key takeaways as we take a look at average net farm income, and we'll, as we go through this document, spend a lot of time talking about that average farm income, the profitability of the farms, and a lot of that is really what does drive the economic returns with strong average net farm income, almost all of the other financial efficiency measures and that type of thing are going to hop into line as well. So again, with the strong profitability, working capital throughout the state increased by over $100,000. And part of that was coming off that 2019 year that all of us remember probably too visibly. And, the issues with the late wet fall harvest, the problems getting crop harvesting soybeans through the mud and on the frost and whatever, the sugar beet people of getting the crop even harvested at all was a challenge. So this past year with some of the government monies, plus pretty good crop yields by most areas and price rebound at the end of the year, all kind of added together with that. So again, one of the other takeaways, like with the working capital, and I'll hit on that a little bit later too, our Moorhead average showed that our working capital of the 80 some farms in our Moorhead average for this past year actually increased by close to $200,000. So even more significantly than what the state average did. And then if we want to roll down to the that bottom table, Josh, and just kind of looking at some of the numbers, there. But when we take a look at, here's how the money is spent in a lot of purpose with this document is this does get shared with legislators and the Minnesota Department of Ag folks, those type of things sometimes. And in a few weeks, local media or state media in St. Paul, Minneapolis will pick up on this, and they always like to put a spin on. But you take a look at what we're trying to get accomplished here is helping people understand what that net farm income does go for. And so you take a look, Josh has got on here, information from going back to 2017 through this past year. The 3 prior years, you look at that balance on the bottom being a negative. And so again, in the top line, we take a look at net farm incomes in 2017, as far as an average in the state, 59,000, 18, even less at 49,000. Last year, a slight improvement to 73, and then the close to $100,000 increase over the last year by about 100,000 to get us in that $172,000 range. And then you see the other things that farm revenue has got to go for. So to help supplement family living that doesn't come from other off-farm revenues, if that is a situation, we've got to cover our Social Security and income tax liabilities, health and medical expense that we all know has gotten to be a very significant part of our living expenses, especially if you've got to pay that premium out of pocket. That gets to be pretty blame sizable for many folks. So also to fund retirement accounts and then service any principal requirements that a person has. So this year, like say, we ended up with a surplus for the first time in the last 4 years. So, but just trying to illustrate the where that money does go for. To the next page, please. Okay, here's again a little more detail of the farm income statement and the breakout. One of the key points that I wanted to look at, if we take a look at the gross farm income line, that again you can take a look at from prior years, 2017, 18, 19, we're in the 700 and some thousand dollar gross. This past year, that increased significantly, almost up to 900,000. So over a $100,000 increase in gross farm revenue happening this past year. And my assessment of that, if you go up to the crop inventory change line, you take a look, and in 2020, that became a positive $62,000. And you compare that to even the 2019, it was a positive 13, but about $50,000 of that came from our crop inventory, which again, year-end commodity price that were left on price at the end of the year, as we saw the price rally for commodity crops of corn, wheat, soybeans in particular, brought on a big chunk of that. The other area where most of that revenue came from, and again, this is on a state average, is with the government payments. So you look at that trend history, 2019 was also quite a bit higher with the MFP payment program, which was fairly lucrative. In 19, we had a little bit of MFP that came in 18 as well. And then this past year, with a combination of all the different programs that we had, in that cash part of it, we still got the last 25% of the 2019 MFP, or the market facilitation payment, CFAP 1 and 2 payments. Some people got in their WIP money, and also there could be some PPP money that we put in there if the loan part of it was forgiven. All of those kind of became part of that number. So just kind of moving on, the other part, if we go down to the expenses, on that side of it, again, very consistent. And again, with over 2,000 farms, a high percent of these farms have their information in this database year after year. But look at the consistency across the board. And it is kind of surprising this past year, actually, the total expenses for the year on an accrual basis declined. But again, on a cash expense, they did increase about $50,000 from the prior. But again, with some of the other accrual adjustments, with increased prepays or that type of thing, all comes into play here. And so again, you take a look at the net farm income that we take a look at, and we've talked about, again, about $100,000 higher in 2020 than the prior years. So I think the other thing, if we look at the bottom chart on this page, and again, you can kind of see the increases in 2020 by the type of revenue. So we've got it broke out by crop income. So once again, you see on the crop side where it had been averaging that 370 some. This year it went up about $40,000. And again, pretty much assuming that a lot of that did come from the significant increase in soybean price at the end of the year, as well as the corn price rallying towards the latter half. I know a lot of bushels did get sold at less than current prices by far, but yet from the prices that we had been experiencing the last 3 years, I think people still averaged above where we'd saw things in prior years. So to the next page, okay, so one of the other things, if we go to that the solvency section, Josh, and highlight, I just wanted to point out that it's kind of interesting how this year that, when we take a look at net worth change, and that when we talk about the net farm income on average was 173, we actually saw a net worth change on a market value basis improved to 184. So virtually most of that net farm income was able to be retained and became equity. And it is kind of surprising, people are going to kind of look at it. Well, out of that net farm income we just talked about, well, that also has got to go and cover, our family living and those type of things. The other thing, when we look at the balance sheets, we do have revenues coming in from other sources, especially for the sole proprietorship operations. So again, if there's growth in non-farm investments, if there's a working spouse with a 401k plan, we saw some pretty significant improvements in some of those non-farm investment accounts this past year. Appreciation of some assets, can come into play here as well. So, but again, you take a look at, there is a pretty good trend of how the net farm income does correlate back with the with this change to net worth, and where the profit turns into equity. And I was just going through last night and found one of, I thought this kind of portrayed pretty well, but it's a statement that I had jotted down from listening to one of Dr. Cole's presentations back a year or two ago. And he talks about cash is queen, equity is your king, profit is your kingdom. So that's what we're trying to get through here, is that when we do have profitability, it takes care of a lot of the other business factors that we have to deal with. So if we want to go down to the chart, Josh, and this one, I just wanted to touch base here again on the working capital. Take a look at just statewide again, how that changed. If we look at 2019 and the prior years, where we'd been in a trend down with working capital, and that working capital to gross revenue percent that you see in the center of the bar in the yellowed section, we've been hovering in that low to mid 20 percentile, which is a little under our guideline where we'd like to see working capital at. This past year, with that $100,000 plus increase, has moved that percentage back up by about 8% or 8.5%, up to almost 32%. So, like I say, one good year really did bring some of those key financial measures that lenders and other financial experts take a hard look at. The term debt coverage on the left-hand chart, once again, we take a look this past year for an average to be up in that 2.6 area, very positive. So the majority of farms really did have a strong 2020. When we further analyzed the data, when we started looking at some of the low percentile group, some of our findings did show that we had about 20% of the farms did show some financial adversity due to a combination of things. I know some of the people on that are students of mine probably alluded to that my home farm, or my brother farming in Rosa County, especially on his wheat crop, probably the worst wheat crop that he experienced in the years he's farmed. But when you get 20 inches of rain, pretty much in the within a month after planting, not too many positive things come out of that. So we did have some pockets, especially up in the northern tier counties, coupled with that late fall that we had, a later spring, and then you throw on significant rain events in June and early July. It just did not make for a great year for that small geographic area. Okay, on to the next page. Okay, just a couple points on this one. If we take a look at the profitability measure, on the cost base, primarily with the rate of return on asset, rate of return on equity, you take a look at where those numbers have been hovering in 17, 18, 19, in that 1, 2, and low 3, and the rate of return on equity even less than the rate of return on assets. That's one of those things I mention or try to mention every year, that you know, the rule of thumb is when your borrowed money is working effectively for your business, that your rate of return on farm equity should be higher than what your rate of return on farm assets are, which that is the case of what we see here in 2020 with a rate of return on equity at 10.5% and the rate of return on farm assets at 7.5%. Both of those measures very strong and a good position. So just trying to make the point that, you know, the economy in Minnesota had went through a very challenging time financially with the low commodity prices, some weather issues, the trade wars, all of those type of things. Finally, this past year, a number of things broke loose to the farmers' favor that, you know, allowed for some return to some decent profitability. The last point I wanted to get to would be on operating expense ratio. We look at the efficiencies, and actually, if we really look at the operating table, the 10-year information really kind of shows, if you remember back 2011 and especially 12, our record farm profitability years, where that operating expense ratio, and it's one of those things that when you have higher revenue, that expense ratio goes down. And I had pointed out earlier where a lot of times our expenses for a farm, if you're not changing acreages or significant change to crop rotation, your farm expenses generally stay quite consistent year to year. But what changes this ratio is how much revenue are you bringing in. So when we had those good yields and good commodity prices brought in more revenue, you go back to that time, we're down into the 60-some%, which is a great place to be. That's leaving a lot of room then for return to, as far as the net to the business or to the business owner. We take a look from that stretch of 2013 to 19, where we're, you know, with the exception of last year, just barely got under 80%. But those prior years, you know, we're all in that 80 to a little bit higher than 80%. Again, this year did help to bring us down significantly, got to a comfortable level at about 71%. And that is one ratio, this operating expense ratio. In the 31 years I've been doing this, it's I've really kind of looked at, and we've talked about over the years of, you know, why do we see such a spread in profitability between our high profit group, low profitability group? And if I can put my finger on one key ratio that really does separate out those higher profitability farms from the lower ones, are farms that can keep that operating expense ratio into that 70% area on a, you know, multi-year average, are going to do very well. When you're up in that 80% plus, profitability, cash flow ability get to be pretty marginal. So just want to kind of point that out, something for you to track on your individual farms. When you look at doing your typical cash flow plan, that ratio is illustrated on the cash flow plan as well. And like say, if you're getting up there on a projection into those upper 80s or that type of thing, just not leaving a lot of room, wiggle room, or a lot of room for profit. Okay, let's move on to the next for the. Okay, the other section I wanted to look at, here's where we're breaking it out by the different 3 different state reports plus the state average that we've looked at. So 2,246 farms. Our northern Minnesota report, we had 577 farms. The southern area, which pretty much is all of the farms in pretty much south of from St. Cloud, you might say, straight across to both the South Dakota and Wisconsin borders, and all the way down to Iowa, fall into that area. There's about 40 instructors that provide data to that data set, and there's about 20 some of us that provide data to the northern report, and about 8 of us that provide data to the Red River Valley report that we had 126 farms in. So I did want to point out, like say with the Red River Valley, just that, the gross amount of gross cash income, again, you can see at 1.2 compared to the 800 and some thousand on a state average. Average net farm income higher than the other groups by about 40 some $1,000, as well as the median. But then we do take a look at some of the other examples and how some of these numbers roll together. If we take a look at the working capital section, it's interesting to look at, once again, the Red River Valley farms showing the highest dollar value of working capital at $355,000. The southern group at 295, and the northern group at 240. But once again, when you do take a look at the working capital at gross income, percent for the valley is slightly less. Plus the term debt coverage for our valley farms ended up being less than the other 2 groupings. So, it kind of points out why we have as many different measures that we do have. Typically, a farm may be strong in certain sections of their balance sheet, or their cash flow ability is strong, but balance sheet has weaknesses due to working capital issues, or just overall equity in general. So those were the couple key things. The other main thing with this breakout, and we'll touch base, is when we go down to the crop acres and machinery values. And I know I've touched base on this in prior years, but when we take a look at those total crop acres for the state, we're at 800 or 786 for this year. Our northern Minnesota group at 228, the southern Minnesota at 671, and our valley average at 2,006 acres. And actually the Moorhead average for this year, we're at 2,145. So just to kind of give you a comparative. Now, when you take a look at the machinery cost per acre, and that takes our market value of the equipment on the balance sheet, it takes an average of beginning and ending values of that, and simply divides it by the number of crop acres. So as I've talked in other years, but you take a look for our valley, we're at $433 compared to that southern Minnesota group, almost at $800 per acre. And the next table we'll get in and take a look at the breakout between farm types, as we break farms apart in another section. So if we do take a look at the this table, we break it out by what's referred to as farm type. And so we start out with the our straight crop farms. So to be considered a crop farm, 70% of your gross farm income needs to come from crop and crop related sales. The other area, so like the dairy, in that case, be considered a straight dairy farm. Over 70% of all of their revenue needs to come strictly from milk sales is the rule of thumb. And so to be considered a straight or a beef farm, some type of beef sales, either beef cow calf or beef finishing, those type of operations. Once again, that's 70% of the revenue is the dividing line. So once again, you do take a look at, for example, like say with some of those hog operations, there are some pretty sizable units in there when you look at gross income, especially those hog breakouts, the hog and hog crop ones, and even some of their average net farm incomes came to the top of the heap this year. Plus the dairy farms this past year also had a very good year. But the other thing I did want to point out that is kind of interesting and helps people understand looking at this. So if we want to slide down and to that total acres and machinery values. So again, on a statewide analysis, we take a look at the crop group. And so this is all inclusive of, Red River Valley, North, South crop farms with very little to no livestock tied up in their operation, average of 1,049 acres. Their machinery value per acre at $565. So again, just seeing that illustration that on average, the Red River Valley machine costs tend to be a little bit less. Ties to just farms covering more acres, and especially with our small grain and soybean acres, people can be pretty efficient compared to southern Minnesota, where with the corn and number of bushels, with some of the yields that they get, just more trucking, that type of thing, and it's just a little different system. When we start seeing some of those reasons for some of the high increases, where we do look at the livestock, so like the straight dairy in the next table, their machinery cost per acre at $1,366. Average total acres at only 470. So these again are farms where there's a lot of that value of the machinery on their balance sheet is really for the dairy operation with TMR mixers and manure hauling, manure spreaders, different skid steer loaders, bobcats, those type of things for feeding. That type of thing. Plus, again, most of those crop acres are going to be for raising intensive alfalfa production and a lot of corn silage that are very machinery intense. So you just kind of start to see a little bit of a flavor for that breakout by type. So I think we've hit on that enough. And then the last page, just a quick blurb. The last dicing here is breaking out by age, number of years farming. So we do have just the 10 years of farming and under, which kind of follows our Minnesota guidelines for a beginning farmer, falls into that category. Then the 11 to 20 years, 20 to or 21 to 30, 31 to 40, and the above 40. It is kind of interesting when we take a look at Again, the average net farm income, and a lot of these things just stand to reason that that average net farm income, you just take a look at both the average farm income and the median. The more years that a farm's been in business, the higher that net income gets to be. That's what it's showing this past year, and usually would be typical. Years like last year did throw a wrench in some of those things, that it was just one of those years that the more acres that a person had just seemed to magnify how much the loss was. But we get back to a little more of a traditional year. And I'm not saying 20 was a traditional year, but just strictly looking at it from financial numbers is what I'm getting at. But it is interesting when we look at the comparative of rate of return on assets for that low group or the beginning farmer group. Rate of return on assets at 9.8 and rate of return on equity at 18.1. That's one of those things where it's just how the ratios get calculated. And, you know, those beginning farmers, many times they're renting all their land. They're probably using a lot of their parents and or uncles or grandpa's equipment, or getting help from somewhere to get started. Most likely don't have, you know, any own land or beet stock, you know, yet in their name, or a very modest amount. So if they have any significant amount of farm profit, all of those measures tend to look much better. So the more farm assets that a person accumulates, and I've talked to you know, several of the farms I've worked with over the years, that, you know, it is difficult if you own a significant percent of your farmland and a lot of your or all of your beet shares. It's really tough to get your rate of return on assets much over that 3 or 4%, even on a good year. So just kind of wanted to point that out, that like I say, you do have to kind of know behind the scenes, you know, some of the things going on that helps generate some of those numbers. So let's move on to the our Morehead table. Okay, just wanted to touch base here really quick on our financial scorecard, and just kind of just, you know, concentrate a little bit more on our local area. As we've talked about for a lot of years, it does make it difficult, you know, to make long-term decisions just off of 1 year's information. Like 2019 was a perfect example that so many farms just showed extremely dismal profitability measures with a lot of negatives. And if you were to just look at that 1 year, it's like, why am I doing this? And then you turn around and you think back to like 2012, where we just saw some record profitabilities. And in some cases, you know, I've witnessed where some people did make some pretty significant investments, thinking that we would see those commodity prices stay at those levels. So that's where it's kind of nice to look at these current measures over a trend. So this year it is kind of nice just to show that improvement, and we've, you know, hit on this in a lot of ways already. But just again, this is our immediate group for our Morehead area on working capital. Our 5-year average, and that is again including this past year, which was, you know, by far the best of that 5-year average. Like working capital, the 5-year average at 300 and some thousand. Working capital at gross revenue at 27.1%, and just the standalone 2020 working capital at gross revenue at 32.5. So again, just also illustrating that our Morehead numbers compare and come in fairly close and kind of mirror a lot of the state data that I just covered. Solvency, I just wanted to touch base real quick. Solvency generally is one of those that it's tough to move the bar a lot in a short period of time. That's just one of those things that's kind of a long grind. So again, even like this past year, we saw a 2% increase in equity to asset ratio compared to the 5-year average. Then when we take a look at the profitability by cost measures, the equity in asset ratios. So again, our 5-year average for our Moorhead group, rate of return on assets at 3.4%, 2.8 on rate of return on equity. This year, nice rebound up, 6.3 and 8.2% rate of return on equity. So once again, one of the other things I wanted to comment, or I'll wait until we get through to the bottom here. But term debt coverage, once again, significant improvement, almost a 1% or 100% improvement over the 5-year average, which was significant. And then if we drop down the efficiency measures, once again, the operating ratio I talked about. So our Moorhead average, we're at 73%. Compared to the state average, if memory serves right, was 71. So we're right in line there. And once again, our 5-year average was just about 78%. So we do see a nice trend down in that format. And then the net farm income ratio, our 5-year average at 11.2, and this year at 17.6. So when we take a look at the excuse me, the green, yellow, and red bars. Green again is the area that we'd love to be in all categories. The yellow is middle of the road. We're doing okay, but if we get to the closer to the red, it's kind of a warning sign for that given area, and it's fine to be in the red cell in a handful of those categories. But as I was kind of going through and just thinking about this presentation, of those bars, we have there's 15 of them that we have the green, yellow, red bars, and I took and trend lined or marked off an X for our 5-year average for all 15 of those. And it turns out that for our last 5-year, for our Moorhead average, 10 of the 15, we end up in the yellow at one end of the spectrum or the other, or right down the middle. 4 of those 15 measures, we ended up in the red, and only 1, and that was the interest expense ratio, did we plot out in the green area. And that interest expense, a lot of that is tied back, not so much from the lack of debt load carried, but the extremely low interest rate volume or interest rate time period that we are going through. So with that, I think we're ready to go over to the PowerPoint, Josh. So I've just got a couple slides that will pop up on that. Okay, so one of the documents that we will be either mailing out or hand delivering to everybody in the program is our Moorhead Morehead averages, and we put together a quick summary, very similar to what we saw on the prior prior documents, but just looking at it, this year we had 87 farms between Josh and I that we included in this, included in the data. Average net farm income for Morehead average at 237. So we're about $24,000 higher than the Red River Valley, and over 50 some thousand, or probably close to 70,000 higher than the Minnesota state average. Once again, I talked about our average acres for the Morehead group was 2,145 crop acres, of which 404 acres on average were owned by the farms. Now, again, one thing that in the years I've worked with Josh down at Morehead, that just the way we put the information in does kind of skew the data with a number of the entity operations that we deal with. There is a fair amount of the land that is owned by the owners themselves on a personal basis, and then rented to the farm operating entity, and that's where that number of acres does get a little bit lower on a percent than what I would like to say truly does exist. So, but that's just how our the data does get calculated. Probably not a surprise to most, but again, kind of along that same theme of there is a fair amount of land owned by the business owners personally that are rented to their operating entity. So the largest expense category in our Morehead report is for land rent at over $225,000, and that equates to an average of just about $134 per acre. So looking at the data, there's 1,690 rented acres on average per farm. So that was the divider for that $225,000 rent calculation. So the other highest expense categories were for seed at over 173,000, followed by fertilizer, and then chemical, the fourth highest amount at 107. Okay, then when we take a look at the again 2020 net farm income, breaking it out by the different profitability groups, just kind of wanting to show again quite a difference in size and scope, and there is no real such thing as an average farm. They're all unique in their own way. The top 25 percentile group had gross income of over $2.5 million compared to the median group or middle of the road. So out of the 87 farms in this database, that would be the midway point to roughly the number 43 farm in the middle here would have had net or gross farm income of about 947, and the low profitability group at 878,000. Soybeans were the crop that generated or had the largest amount of cash sales for the 2020 year. And once again, as we talked about, the other are the government payments that we included with the other government payment section on the FinAn reports was that third round of the MFP, the CFAP 1 and 2, along with the WIP Plus and in some cases, the PPP forgiveness or loans that were forgiven. When we do take a look at our Moorhead average to the Red River Valley report that also just got completed yesterday and is off or at the printers over at NDSU. But again, just looking at that data, so once again, our Moorhead average, we were about 100 acres more in scope than the Valley average, and you can see the Hyde group, our Moorhead group, about $100,000 more compared to the entire Red River Valley. So our Moorhead group does make up about 40% of the entire Red River Valley database that you'll also get to see here in the next week or so. Okay. Okay, then the looking at it in just another different way from net cash sales. So this is after all expenses have been paid and before we take a look at accrual adjustments. So again, some of this is where we're looking at managing for income tax and that type of thing. A lot of times this cash, net cash expense usually gets to be more averaged out than what we'll see on the, as far as the net profits, where we do come in with the accrual adjustments and that type of thing. But again, you can just kind of see the high group at 400 and some thousand, the median group down at 173, and our low profit group at 64,838. That's the only one that kind of is a little variant from what the Red River Valley, where their low net income group was at 109. So on average, that ended up quite a bit higher. Josh and I were kind of talking about, what might have caused that, and might be just a case of a few more beginning farms in our group, or we also did have a couple farms that did experience some pretty good losses as well. So it's just how the numbers worked out. And I think there's one more, and then turn over to Josh. Okay, just kind of in the Moorhead summary that you get to look at, or we'll review with you over the next time frame. But once again, on the working capital for our Moorhead group, did improve by over $200,000 from the end of 19 to 20. The working capital of gross revenue that we've talked about went from 21.6% to 32.5%. So, close to an 11% increase, which was really, really good. So once again, this past year, good illustration why we want to look at our businesses through an accrual adjusted method. Profitability in general for the year in 2020 was good, but like I did mention, a few farms did experience some setback, but as we also alluded to on the financial chart, our rate of return on assets and rate of return on equity, very acceptable levels at 6.3 ROA and return on equity at 2.8. So overall, good strong financial year, and things are set up going into 21 in a pretty good, much improved state over where we were at this time a year ago. Okay, turn over to Josh.
Thanks, Ron. And like you said earlier, we will be sending out copies of the Moorhead Executive Summary, the Moorhead book and the Red River Valley book once we get the copies from NDSU. So we're hoping that we'll have the Red River Valley book. The Moorhead books are all done, but the Red River Valley books hopefully in our hands by next week. And then we can get them mailed out to you by the end of the week is kind of the goal. So I just want to talk a little bit about kind of some 2020 crop data information comparisons. And I'll be kind of talking about our Moorhead group and comparisons to the Red River Valley. And then we'll do a little bit of marketing update as well. And again, this recording will be available if people want to go back and watch it later. It'll be linked to our website as well. So the 5-year average on a corn rented, this is page 36 of our book when you eventually get that. And so the yield on the corn, this is on rented ground, and this is comparing our 5-year rented ground average with our 5-year or with our Valley 2020 averages on rented ground and our Moorhead group. You can see that, we were a little bit below the 5-year average on yield and below the Valley average on yield. Again, the Valley information, like Ron said, we account for about 40% of it between Ron and myself with these 87 farms. But we go all the way down kind of south of Wahpeton, Breckenridge area, and then we go all the way up to north to basically the Canadian border in the Valley. So gross return, we actually had a better gross return than the Valley did. And much better than our 5-year average. Now included in this gross is this other crop income. And I put that information there that the CVAP payment and the cash dividends is included in that. And last year for most corn producers, the CFAP 2 was somewhere in that mid $20 to even mid $30 per acre range. Direct costs, you can see we're actually a little cheaper on the direct cost side than the overall Valley. Now included in there would be land rent. And then direct and overhead, we're a little bit cheaper. So we actually had a higher net return per acre than our 5-year average and higher than the Valley. The chart on the right side, you'll see on each of these 4 next slides are a breakdown on the Moorhead group. The overall average expenses per acre spent on seed, fertilizer, chemical insurance, fuel, repairs, land rent, all the other direct expenses, and then the overhead expenses kind of split up into a pie chart. So you can kind of see where those expenses lay. So you can see on average, our seed cost just under $90, fertilizer is about $118, chemicals just under $31. Land rent for our group is $122. The one thing that's unique there, you'll see is when we get to our other 3 main crops, is that for whatever reason, our corn, if we had a few more people with our lower land rents that had corn on it, or what the reason was, but our land rent per acre on corn is a lot lower. When we go to wheat, soybeans, and sugar beets, you'll see it's kind of more of a typical for that range. So it's just kind of a weird anomaly of who and where they had land rent on corn this year. On soybeans, you can see our actual Valley yield average. We were below the Valley number, below our 5-year average at 37.3. Gross return, again, this includes a $15 per acre payment for CFAP plus some dividends, but we were a little less than the Valley. Excuse me. Direct cost was just a little bit cheaper. Direct and overhead about $7 cheaper, and you can see our net return was very comparable to the Valley's, up about $1 and up about $11 compared to the 5-year average. Here you can see in land rent, notice we're back to about that 135 average compared to the corn number, and that's more comparable to, and understand that land rent, this is actual rented land. This isn't land cost divided out, because Ron showed that 133 divided by all acres on the land cost. This would be just specific land rent to soybean acres. So again, it depends on who had what acres in soybeans and their land rent cost. And I know some people always say, well, that's not the average cash rent, or that's not the average rent I'm paying. Well, obviously we always talk about it being an average. But part of that is, we have to understand that our location, we go all the way down. I have some farms down by Breckenridge. We go all the way north to almost Crookston with some of our farms. You can see differences in land rental rates there. I do have some people that still have some family land rental rates where they're paying, less than $100 per acre to their family, because that's the deal that they've worked in. You average that in with people that have over $200 per acre land rent. That's where we get that average number. Wheat, And I think this is interesting on the Valley because typically we've seen the Valley number be higher and actually be profitable. But in 2020, we actually had wheat on rented ground actually lost money at $14 an acre. And in the Moorhead group, we lost about $20 per acre. The gross return number include, again, wheat was about mid 20 range for the CFAP payment, kind of depending on what your individual yield was on that, and then some dividend money. You know, we had a little bit better yield on the Valley. I understand that we get further south, we tend to get a little bit lower yield. Direct costs were a little bit higher than the Valley, and direct and overhead was a little bit higher. Hence the reason we had, even with a better yield, we had a little bit less or lower net return. And again, we see that land rent again in that mid upper $130 range from that. The other thing that always gets talked about, and I have some issues with some bankers sometimes, is they look at the seed costs and they say, well, the average seed cost is X amount, that's what should be on the cash flow plan. Well, some people are using their own seed, some people are cleaning and doing that, some are using a hybrid of some bought, some cleaned, and some are completely buying it. So this is kind of a mixture when we look at total seed expense per acre. And then when we go to sugar beets, this is on rented ground without joint venture. And you can see that, you know, we were slightly better than our Valley average book information on yield. This includes, of course, the Mindac people down in the North Dakota side, but also includes some Northern Valley as well. You can see for the, you know, we were back over $1,000 on a gross return. CFAP 2 this year for sugar beets was $15 an acre, and then a little bit of dividend money. You can see our direct costs were a little bit higher. And of course, that land rent you can see creeped up to about $145 per acre. Direct and overhead just under $1,100. I think that's kind of the new norm when we talk about what's needed to break even. It used to be about $1,000, but I think about $1,100 to $1,200 is more what most farms are needing to break even on rented ground on sugar beet. You can see the net return per acre is a loss of $92 an acre. And again, this is excluding any joint venture. This is rented ground on owned stock. You can see the Valley was loss of 61. Now the 5-year average, even with this loss this year, is still a positive $16.75 per acre. So just some quick analysis comparing 2020 to 2021. This information comes from all of you that did a cash flow plan with Ron or myself. We also do that 1-page cost of production, or some of you have a more than a 1-page one, depending on which one you chose. But you have the cost of production summary on an Excel spreadsheet. We take that number, I put all of them into a separate spreadsheet on what is your exact cost of production per acre on corn, soybeans, sugar beets, wheat. And so the 2021 is the calculated number from those Excel spreadsheets. The 2020 number is taken directly from your financial analysis that you completed with Ron and myself. So the difference is on our cost of production, we use your actual family living cost, and instead of depreciation, we use your principal and interest payments that you pay for your farm instead of depreciation. So for some farms, those numbers are very comparable, but for some, we calculate a labor and management charge as part of the financial analysis. It's 5% of your value of farm production plus $25,000 for every operator. So instead, we use actual family living and what I call is your true cost of production, because it takes your actual cash expenses expected for the year. So there's a little bit of difference there. And of course, obviously in 2020, we take actual yields that were brought in by those farms, those 87 farms, versus in 2021, we actually might have more than 87 farms because we have some that are some beginning farmers that didn't do analysis or at least had a cash flow plan prepared. And this is what they expect their yields to be. So a lot of times they go with their 3-year averages or closer to their recent averages. But you can see average cost of production is almost identical to a year ago on corn. The low side is a little bit lower, and the high side is, of course, a little bit lower as well. And a lot of this is coming into what they're expecting. They're having to pay out for family living. We're also bringing in some money, additional money for CFAP3 and some of those cash flows. And then I do have some farms that basically their non-farm income pays all their family living. So they would have no family living cost in 2021 on their cash flow plan. But in 2020, we'd have that value of labor and management, which is basically a proxy for what the farm could support of somebody of your management to do your job on the farm. So soybeans, we see a little bit higher cost production, 849. Obviously in 2020, we're helped quite a bit with some of those additional government payments and such. But you can see the low number is almost identical to a year ago, and we're just a little bit lower on the high side at $10 versus $10.33. Spring wheat, the average is about 575, and I think this will become important when we talk about some of the plans and the marketing part next. The low end is just over $4, and the high end is almost $7 per acre. And again, a lot of that depends on family living costs, number of acres, and what you have individual yield projected at, and you have an individual expenses as well. And then sugar beets, this is where we're seeing the average at about $41. The low end is 29. So this one would include, it'd be a mixture, and this would include joint venture for those farms that do have joint venture or stock quota lease costs. So that number is included in this. This number would include that as well, but obviously last year there was a lot of zeros for anybody that wasn't growing crystal beets. So that lowered that number significantly. In 2021, you see the high end is just under $50, very comparable to 2020. And then the question always is kind of what's the acre decision? You know, people ask me all the time, like when prices are changing, you know, are farmers changing their acres, or what's their, you know, rotation going to be, or what are your thoughts on that? So what I did is, again, I took their actual information from the 2020 plans, just because it'd be very difficult to do it from 2020 analysis. And their 2021 cash flow plans. Here were the initial plans for 2020 for corn percent of acres that they grow. Okay, and so we have a few more acres in 2021 than we did in 2020. And again, most of our group is pretty static, but we do have some new additions, and we do have some changes. People that bought land or renting more land or whatever, that changes that number. But you can see corn's up about 3%. Almost 4% on expected acres for 2021. Soybeans is up almost 10%. We see wheat down by about 5% on average. Sugar beets is down about 2%. And then our other crops are down about 6%. So other crops would be things like sunflowers, seed soybeans, food grade soybeans, barley, hay, silage, other classes or categories of wheat. I got a few farms that have, you know, they have additional acres that they custom work or they rent out or whatever that are still part of their plan, that are part of their
Josh?
total acres. Yep.
My screen's
sorry.
stuck on corn.
Yep, sorry.
Okay.
Let me go back real quick. So here's the soybean numbers. Yeah, I got it on a different screen and I'm looking at two screens at the same time. Here's the wheat one. Thanks for telling me that, Wayne. Here's your wheat numbers. Here's your sugar beet numbers. And then here's the acre numbers that I was talking about. So basically what you've seen is we're basically pulling from other crops, and wheat are decreasing as a percentage of the acres planted on the farm, and we're increasing soybeans and corn. That's really where we're pulling those acres from, and changes. And obviously there's, you know, we've got additional acres, but this is percent of the total acres that the farms are growing. So you can kind of see that on the charts here. It does round it up here. It says 42.8, but 43. So, you know, it is kind of adjusting those a little bit. Any questions on that? And then I'm going to transition into the marketing update. We'll take this time to see if anybody's got any questions for Ron or myself. Okay. I don't hear anything. I'll watch the chat if anybody has chat or whatever. Again, we'll have opportunities for questions at the end as well. So I'm going to do kind of an abbreviated marketing update, not the same one that I would do with my marketing group, but some of the similar things just to talk about marketing outlook. I want to pull back to these numbers real quick. On the corn, when we talk about cost of production, so let's talk about this 348 number, 850 on beans and 575 for wheat. So to me, that would be numbers that I would start out with as a producer, and I would take a look at that numbers as starting points on my farm, whatever my average is, as a minimum starting point to start making some sales. The other side of it is FSA did come through here at the end of February, and they did update their planting prices. And so we're now up to 375 on corn. We're up to $10 on beans, and we're up to 550 wheat. That's the numbers that they're using. So, you know, most of you, that's the numbers we were using already. And we did that ahead of time because we felt that those numbers were a little bit low, what initially was thought of as plans. But obviously it just makes those cash flows work better if we use higher prices. So real quickly, one of the things we always go through is kind of the normal chart where we're at. And one of the things that you see here is this is from October 1 to basically December of the crop marketing year. So this is like, for example, this would be 2021, October of 20 to December of 21. What typically happens in normal futures prices on corn. And obviously this year is outside the norm with such short ending stocks and low supplies. But what we see here is we see the start to development of a very seasonable trend in March to late March to then pick back up in April. And that there really isn't a lot of news from now until the end of the month. So we may see a very strong trading range. We may actually see a pullback in prices for the next few weeks without any extra or exciting news on the horizon. They're really going to be watching for that planted intentions report at the end of March here on the 31st, and an update to the grain stocks numbers at that same date. So that could be a very interesting day in the markets for all three classes. Soybeans, we see the same thing. We see the steady climb, again, very typical of an annual report. This is from 2018, but we would see very similar numbers even if we added in 19 and 20. 20 would be a little bit outside the anomaly. But what we see is usually a little pullback in March. We get to that end of March, that planting intentions, usually not a lot of news to that. And then we see another rally up. And then we tend to see an upper price range, typically in that May, June, July timeframe. As we get into planting, we get into weather-related issues, and then that early reports. And then usually by that July report, historically speaking, it really moves the markets one way or another. Either it's going to go up or it's going to go down. Here's our soybean chart. So again, very typical. We see this time frame where most sales are usually at their highs. The one thing that we did when we met with NDSU and the Red River Valley report, we had an opportunity to sit down and talk to Frayne Olson for, probably longer than we initially thought, but probably for about 15-20 minutes, just on things of what's happening in the report, and are we going to get $7 wheat and what's happening. And so he kind of walked us through a whole bunch of scenarios. And one of the things he said that I talked about our Ed Usset presentation, and he said, he goes, if you look at Ed's chart where we showed these low ending stocks in whatever situations where the prices from February 1st to harvest, on average almost every year, save for a few, dropped. He said, he goes, if you exclude the years where it's a demand driven number, he said, he goes, it's almost 100% of the times where that price is going to drop. He goes, we're in a situation where this is a demand side where we've got way more demand than the supply indicates, and that's what's pushing it versus just being a short supply. Think drought seasons where we'd have a short supply or worries about short supplies that move the market. He goes, where this was a demand side, he goes, and then you get into the situation where if we do have dry conditions or do have drought, that's why we say it saw a lower price or see higher prices in that 2012 instance after harvest because of the drought conditions during the growing season. And then in wheat, again, we see a very typical chart. As we get into February, into March, April, May, we kind of bounce around and stay kind of in a trading range, kind of at the higher end of the range. We're seeing us kind of developing that pattern here. This chart is about as close of approximation of the September chart as I can get to that same time frame here. So we see this little pullback here in March. Again, most of the time, this is kind of right around or prior to that planting intentions report and the grain stocks report. We usually see a pull up on that, depending on that. It will be interesting to see what wheat will do and what spring wheat does. One of his conversations on the wheat market, and this is kind of leads us to this chart here, is there's a lot of these concerns about the drought. Although this last week, a lot of these areas got rain. So today's chart that will come out will probably show some improvements in these areas. He talked about the amount of rain that's needed. When you get in these dark purples and even these bright red colors, that's significant soil loss, and it's deep into the soil layer. Where he says when you get these lighter yellows, he goes, that's only a few inches into the root layer. He goes, that's not as big of a deal. If you get normal rains in these situations, even in these lighter tan areas, if you get normal rainfall every week or so and get a good soaking, you don't need to have a lot of subsoil moisture to rely on that. He said the problem is if you have dry conditions and you stay dry through the growing season, there isn't subsoil moisture for that crop to tap into, and that reserve isn't there. So he said, you can have dry conditions, and if you have good rainfall throughout the growing season, you can have a record producing crop. He goes, it's just when you get into these areas where it's really dry, severe drought or extreme drought, that they need a lot more rain, and they need, there's nothing in the well, so to speak, to draw from if they do have continued dry conditions. So that crop is extremely dependent on rainfall throughout the growing season. Crop prices, these are on our website and sent out with our meeting announcements, but this was yesterday, kind of mid-afternoon. You can see like old crop prices on wheat, just around that little under $5 or $6. Our new crop, we're bouncing right around that $6 cash number. Soybeans, you see that, $1.60 difference from a $13.30 old crop to $11.70 new crop. And I go back to like break evens, we're $8.45, $8.50, we're $3 better than that. We're at $5.75 on average. We're better than that, and we're $3.50 on average on corn, and we're about almost 80 cents better than that on new crop. And old crop, obviously, we have $5 plus corn. And I think the hard part for a lot of people is the fact that, in the past, the people that did good jobs pre-marketing and marketing their crop in a year like 2020, and sold ahead of time or sold at harvest or whatever, and did a good job pre-marketing and what they thought was the best get bit because all of a sudden something happens, and now we're staring at $5 corn and $13.50 beans, and most of the people on average sold it for $9.20 or $9.10, and so they get gun shy about making any additional sales. And I guess I would say that if you look at those producers over a 10-year trend, 80 to 90% of the time, they're selling at better prices and more profitable levels than the average farm that's not doing that. It's the years like 2020 where you have the people that didn't market ahead of time, sat on their crop, didn't really have a plan, just sat on it. And by January, February, and even March, that crop's worth a lot more than it was at harvest. Most years, and you saw that with Asset's presentation, that producer is actually below the average producer that does some pre-marketing, but it's in these unique years where we see those trends happen. So I caution farms to get too caught up in the like that's going to happen again, and I don't want to miss out on that. He did a really good statistical analysis, Frayne did for Ron and I. And he showed kind of this, typical bell curve of pricing or whatever. And he said the chances that you're going to sell in the top, at the highs or even in the top third is less than like 10% of the chance. It's not 33% of the chance. It's less than 10% chance that you're going to sell your grain in the top third. He said, he goes, when you take a normal, and he gave us a good stats lesson on a bell curve and, the standard deviation from the center point out and for each third. So, it's a significantly small percentage of farms. So he goes, if you can shoot to sell in the top half of the farms, he goes, you're doing a really good job. And he goes, if you're selling in the top third of the prices, he said, you're doing an extremely good job of marketing. And he goes, to say that anybody sold at the highs for all of their crop, he said, is almost non-existent, because he said nobody's selling 100% of their crop on one day and hit that high, and to predict those highs is extremely unlikely. But you can see basis levels have held relatively steady on new crop. Old crop, they've actually tightened up a little bit. And I think that's just a good indication that supplies are continuing to stay tight and will continue to stay tight, at least until we get some more South American crop online and delivered out. And then to see what the South American second crop corn has as well. One of the things he did talk about, and I go back to this drought monitor map, is people keep talking about the wheat concerns and the winter wheat and whatever. And he said, he goes, we have pretty good winter wheat. They're getting rainfall now. He said, he goes, it's not great. We always seem like we're killing it and dying and whatever. But he said, our ending stocks numbers on wheat is very comfortable. Not like it is in soybeans and corn, where we're on relatively low ending stocks numbers compared to looking at the last 10, 20 years of ending stocks, where both of those are relatively tight. And so any more tightening makes the market have a little bit more movement. The overall all categories of wheat, even though it's shrinking, it's still a relatively high number. So he said, he goes, looking at $7 wheat, he said, he goes, looks like it's a little less likely. He said, now the difference is, he said, when we look at wheat and why we see different wheat prices separate from the other classes of wheat, and why we saw some of the soft red wheats and soft winters and stuff like that moved really higher compared to spring wheat or some of the other winter wheats, is that it's very dependent on the commodity product that they're producing with that wheat. And that there isn't a lot of interchangeability on wheat classes by the actual millers, the bakers, as they use it. There is some, but in some cases they really can't interchange that. So he said, he goes, that's why we can see individual spikes. So he said there could be an issue where if we really are short on hard red spring wheat with a lot less planted acres this spring and production that maybe is a little bit lower, that we could see Minneapolis wheat right now is trying to fight for acres with corn and soybeans. We could see where we see a late seasonal rally or a midsummer rally on wheat, but it's probably not going to see a huge rally here in the next few weeks or so as people are planting. So in general, things to kind of think about. I just put on the bottom here, these are the final crop insurance price levels. So it actually guarantees at certain revenue levels, guarantees a good comfort level for revenue. So that gives farmers a little bit more comfort before going into planting. On the revenue guarantees, it also gives them a little bit of pause and some comfort levels on marketing as well. But $4.58 for corn, $11.87 for soybeans, $6.53 for wheat, for spring wheat. So in general, keep eye on spring wheat around the US. Obviously there's rains and it looks like maybe a changing weather pattern for some of the winter wheat drought areas. For the next week or so here. It sounds like maybe even North Dakota and Minnesota will get some more rains here this weekend or so. We'll be continuing to watch weather in South America. There's some dry conditions that are going to aid in harvest there. But we also have some wetter conditions that will help with the second crop corn there. The big thing is going to be this March 31st report on the planting intentions report, say planting decision, but planting intentions. We may kind of stay in a relatively tight range or pull prices back a little bit up until that point. Of course, the planting and the growing season in the US will be very critical. Anything that restricts the actual production will take that lower ending stocks number down, and we'll continue to do that. And really all the thing we can do to ration the demand side will be a raise in prices. It's a demand-based market move versus supply. I talked about that phrase comparison with Ussett's chart. And of course, basis level still being very tight indicates a continued tight supply situation, especially on soybeans and corn. The expectations with export reports coming out today and maybe at the end of the month is that we're looking at potentially even lowering of the ending stocks number for soybeans with the grain stocks report that's going to come out at the end of this month. Corn, obviously there's concern over the second crop corn in South America due to dry conditions and their late planting, what the actual production there is. China has continued to buy US corn, which has caused some people to question how significant. They do have another outbreak of Asian swine flu. So there is some questions about how significant that is. There were people talking that it is significant and could be a concern, but they're also continuing to buy corn at high levels, which is saying maybe it isn't as much. The other part is the US and China are meeting in Alaska this week to talk about the phase 2 trade deal, and there might be some pullback on tariffs. And what else comes from that will be dependent on that trade negotiation. May support prices for corn, 519, resistance is 571. Soybeans, obviously a drier turn of weather in South America supports harvest there. But there are reports of about 9% sprout damage in the actual harvested beans. So the quality of beans aren't there. So, you know, even if they do have good actual production numbers and yields, you take 10% off of that, you know, it puts it back into really a relatively tight supply. Right now, export demand is really turning to South America, but we're well above USDA expectations at this point. Right now, we're at 99% of US expected sales have already happened for the entire marketing year, which already goes until this fall. So either USDA is going to have to raise that, or basically we're not going to sell any US soybeans to them. And if we do, we're going to have to import soybeans from other countries to meet our demand here in the United States. Again, the Asian swine flu concerns in South America are in China. And we'll continue to be watched to see how significant that is. May support 1340, resistance 1445. Wheat, I talked about Frayn's discussion on the wheat pricing already. There's a decrease in demand for US wheat just because as we start to raise our dollar, we become a little bit more expensive to other commodities. We were selling US wheat for other reasons than just the milling side. The better weather that's happening for the winter wheat growing areas. The issue is Minneapolis wheat trying to hold on to acres compared to soybeans and canola. And so we get into Canada, they're talking about like Canadian acres, they're saying even barley. So barley and canola could steal acres up in Canada from spring wheat. And you get into kind of the North Dakota areas or even these northern valley areas that you could see additional soybean acres or even canola. Canola is a very tight supplies. About a week or so ago, it was setting record highs on its markets. And so that can steal acres away from wheat as well. So we could see a late rallying into this summer or even right in around harvest time when we actually get numbers on the spring wheat. So something to look forward to for the 2021 levels and maybe even 2022 at that time. May support at 623, resistance 665. And the last little bit that I have here that we follow with our marketing group is 2021 targets and 2022 targets. As we start to look at comparing back to 2013 and 2012, when we had those rallies, those huge rallies because of short supplies. We saw some really good rallies on the next 2 years worth of crops, and there were some marketing services that made early sales that everybody thought was crazy at the time. And then in 2014 and 15, when they're still selling $5 corn, everybody thought they looked like geniuses. So we're looking at corn. We made some sale at 480 futures. Next target will be $5 plus. Our goal would be to maintain a 430 cash price moving forward. Soybeans, we'd have 1180 target with hit. Next target is 1280, and we've been about 30 cents away from that. Our goal would be at least 1125 cash moving forward. But obviously at 1280, if we sold today, we could be at $12 cash. But you know, we're kind of gambling on our last little bit of pre-harvest sales to see where they're at. Spring wheat, we're mostly looking at December prices. Basically, I'm saying at this point, we're fairly aggressively sold on spring wheat. So the next target, I actually moved to 730, looking for $7 cash moving forward. It would be the next sale I would make on any pre-harvest sales, because we're about 60% sold, based on hitting our targets using that Ed Ussit's and ratcheted up targeting sales. In 2020, actually our first target was 425. We made a sale at that. Next target is 445, and we haven't been that far off from that number. Soybeans, we made some sales at 1085 and 1135. We did a 50-cent bump in prices there. So next rally will be 1185. And then spring wheat, there isn't a lot of spring wheat on the September 22 contracts being traded. So 635, kind of assuming a $6 cash would be our starting point. The only high trade that we made is just above 622 at that point. So just some thoughts on crop targets, on some things that are happening in the market and things that are going to be driving the market. Obviously, we'll be continuing to watch any export sales. And you know, it's not that we're not selling some of these commodities, but when we don't get these big daily announcements, we're just not over the threshold for them to make an announcement. So if they don't get a certain number, they don't have to claim when we're selling 1,000 bushels or 10,000 bushels or 5,000 bushels to these countries. Those numbers aren't, they're getting reported on the weekly sales report, but they're not those big daily announcements that a lot of the market reacts to. So I'm going to stop sharing, and then Ron, if he wants to come back on, if we have any questions at that time. We will send out the PDF of this presentation on the presentation side with the video. And then of course, you'll be getting the copies of all the books. Hopefully late next week is kind of our goal. It kind of depends on when we get the book from NDSU.
Josh,
Yep.
just gonna let you, I didn't give you an update on the diesel chart, but
Oh, yeah.
it dropped as fast as it went up, and it spiked at 260, and just this morning it's 220. So it went up pretty fast there for so many days, and now it's back down to that 220, which is still high, but for a while it looked like it was going to keep going.
But might be an opportunity for people if they haven't done any pre-pricing of spring fuel, they might get a relief now to price now if it does go back up, right?
Yep. That recent spike, that most of that was due to the Texas oil refineries taking their time getting back online, is what the PetroServe guy told me. And they must have come back now that it kind of dropped back to where it was before that. So.
Great, thanks Wayne, appreciate it. Other questions? Otherwise, I'm going to stop the recording.